This webinar was produced by Utah Clean Energy and was funded by a grant from the Southwest Energy Efficiency Project. The topic of this webinar is lien holder consent. The resources available through the Governor's Office of Energy Development program and website, and the information lien holders will want to see when considering whether to grant lien holder consent. Presenting on this webinar are Shauna Kwan, Energy Efficiency Manager with the Governor's Office of Energy Development, and Mark Dupont, Executive Vice President and Chief Credit Officer with First Utah Bank.
Thank you very much for taking the time to learn about Utah's CPACE program. I'm Shauna Kwan with the Governor's Office of Energy Development. My focus is on energy efficiency and programs, but our office is dedicated to advancing all responsible forms of energy and minerals. As we look to the future, it's essential to our economic and environmental success to take an all-of-the-above approach in developing our natural resources. We expect that this approach will provide our growing population with affordable, reliable, and sustainable energy. And our office does this in 3 ways: through industry assistance, education and outreach, and policy development. One area of policy development that our office supports is the Commercial Property Assessed Clean Energy, or CPACE, program. We administer this program for municipalities who choose to opt in with the hopes that our standardized, streamlined program will spread throughout the state. The Utah CPACE 90-second video available on our website provides a great introduction to this program. This webinar is meant to provide a more in-depth look at lien holder consent. So over the next few minutes, I'm going to talk about CPACE, what it is, how it works, and why lien holder consent is needed, OED and the lien holder consent process, and the resources available to you. We also have videos for building owners and webinars and municipalities available on our website. So what is CPACE? At a high level, CPACE is a low-cost, long-term financing option for energy efficiency, renewable energy, or water conservation projects on commercial or industrial buildings or residential properties with 4 or more rental units. Funding is provided through the sale of a bond and can be repaid directly or with the building owner's annual property taxes for a term equal to the life of the improvement, up to 30 years. Please view our Building Owner webinar to learn more about eligible properties and projects under CPACE. CPACE financing is similar to a traditional special assessment financing in that a first lien assessment is levied against property to pay for improvements benefiting the property. For this reason, Utah state law requires that each person or institution holding a mortgage or other lien on the property to be assessed consent in writing to the inclusion of that property in an assessment area created to finance CPACE improvements. While lien holder consent can be a challenge, it's not insurmountable if project financials are compiled in a format that shows lien holders that CPACE will cause the value of their collateral to increase and improve the property owner's ability to make lien payments. In fact, over 100 financial institutions nationwide have consented to CPACE projects. A complete list of consenting institutions can be found on our website at cpace.utah.gov. So how does CPACE work? The first step is for a building owner or project developer to work with contractors to design a project. We highly recommend that an audit or energy analysis commensurate with the technical level of the project is performed. This energy analysis is one of the resources a project developer will use to verify the economic analysis presented to existing lien holders when requesting consent. Second, the project developer finds a capital provider for the project. This capital provider will purchase the municipal bond, the proceeds of which will finance the project. Third, as I mentioned, OED and the building owner or project developer work with any existing lien holders to get written consent for the PACE assessment. Fourth, OED and the building owner or project developer work with the local municipality where the property is located to designate a voluntary assessment area for the property, issue and sell a bond to the capital provider, and levy the assessment. The proceeds of the bond fund the project. And fifth, the PACE obligation is repaid by the property owner, either directly to the lender or through their annual property tax bill for up to a maximum of 30 years. OED acts as a liaison between the parties, the building owner, project developer, existing lien holders, and capital providers. Our role is to facilitate and participate in meetings between parties, present information about how providing consent can benefit the lien holder, work to identify information needed by the lien holder, help building owners compile information needed by the lien holder, including an economic analysis of the project, and present information compiled to the lien holder. Now I'm going to discuss the resources available to help with lender consent, with lien holder consent. All of these resources are available on our website at cpace.utah.gov and are hyperlinked in this presentation. You can access the hyperlinks by downloading the PDF version that is posted online. The first resource is our Consent of Lien Holder to Assessment form. Any existing mortgage or lien holder on the property to be improved must complete the form. The building owner or project developer can submit the completed form to me at utahcpace@utah.gov. As I mentioned before, lien holder consent can be a challenge, but it's not insurmountable if project financials are compiled in a format that shows lien holders that CPACE will cause the value of their collateral to increase and improve the property owner's ability to make lien payments. On our website, we provide a sample CPACE project finance report that project developers can use as a template to demonstrate the financials of the CPACE project in a format that will be useful to mortgage or lien holders. The information gathered in energy analysis or audit will be helpful when compiling this information. Also, PACE Nation has developed a fact sheet that helps lenders understand how providing consent can benefit them, as well as a lender consent handbook, which is a toolkit for obtaining lender consent. And finally, PACE Nation's list of consenting lenders from across the nation is available on our website and can be accessed through the hyperlinked image. If you have any additional questions, please feel free to reach out to me, Shauna Kwan, OED's CPACE Program Administrator. My email address is utahcpace@utah.gov. All of the information you've seen in this presentation and more is available on our website at cpace.utah.gov, including webinars for municipalities and building owners. Also, CPACE Nation is a national organization that provides technical assistance and support to all PACE programs throughout the country. I've already talked about many of their resources during this webinar. Their website can be accessed at pacenation.us. Thanks again for taking the time to learn about CPACE lien holder consent.
Good morning. My name is Mark Zupan. I'm Executive Vice President and Chief Credit Officer at First Utah Bank. Today we're going to talk about lien holder consent. First Utah Bank was involved with the first CPACE transaction in Utah. We were the lender and approved subordination to the CPACE tax assessment. So the purpose of this webinar is to discuss what a lender would need to see in order to agree to a subordination to the CPACE tax assessment. So what is CPACE? And it's an innovative program giving property owners access to affordable long-term financing for clean energy upgrades to their buildings. So how does it work? It's a tax assessment tied to the clean energy improvements to the property. So what's in it for the lender? Let's talk about why a lender would agree to subordinate its lien position to a CPACE tax assessment. There's two primary reasons. It's really a win-win arrangement with the property owner. The lender gets improved debt service coverage due to the efficiency of the energy improvements, and also improved collateral value, which results in a lower loan-to-value on the loan. Customer receives reduced energy costs, and the repayment of the improvements is extended over a longer period of time than a typical bank loan would do. Also, in the event of default of the C-PACE financing, it's just like a tax, and so there's little immediate downside if the borrower misses a tax payment. Unlike a loan that may become payable in full at default, the tax assessment just continues to accrue. And the last reason is it's good for the environment. So what's in it for the property owner? It saves the property owner money and increases the value of the real estate. One of the primary reasons is there's no upfront costs. Typically, a property owner can borrow 100% of the cost of improvements, including all of the fees associated with the bond. And also, it adds no additional debt to the borrower. It keeps credit lines available for the core business needs of the borrower. The payment back, the payment term is longer than typically what a bank would do. On equipment loans, a bank may go 5 to 7 years and require a 20% down payment, where C-PACE financing would go 20 years with no down payment required. Another advantage is this ties the cost of the building improvements to the building, not to the borrower. It also matches the useful life of the improvements to the payback period. Typically, these improvements have a useful life well in excess of 20 years. And the obligation also stays with the building, as does the cost savings. So what does a lender need to see in order to grant consent? Now, this is a pretty comprehensive list of items that a lender would like to see to support a decision to subordinate to a C-PACE assessment. The amount of information required may vary depending on the financial strength of the property owner, the current loan to value on the property, but we're going to go through all of these items just so you can have an idea of kind of what the comprehensive list would be. First item would be a project finance report, and this is very comprehensive, and there's a link here that there should be a copy of this report available to look at. And it would include the property description, financial summary, projected cash flows, key assumptions used, and also a list of the energy conservation measures, the type of equipment, useful life, etc. We'll go into a little more detail in a minute on that. Also, what's important is to look at the dollar amount of the new tax assessment. That would be relative to the property value. The analysis of cost savings is included in the project finance report. And there may be a requirement for an updated appraisal. And this would depend on the current loan to value and also the ratio of the C-PACE lien to the property value. And there's a link here for a addendum that would be required on green projects where there's new energy efficient items added. There's a new addendum that the appraisers will use that will address those items and add the appropriate value to the property. So let's look at the project finance report, some of the details. So the first thing is the project description. This really just describes the property type. In this case, this example is an office building, and it's 95,000 square feet. And then the financing scenario, which is 100% C-PACE financing over 20 years at a 6% rate. So this rate is also, just so you're aware, this is very comparable to bank financing. There's really no disadvantage in going this route in terms of interest rate. Projections. This is very important in terms of looking at the costs and the associated savings. And in this case, the financing in this example is a little over $2 million. The projected cash flows are positive, where we're actually looking at a projected average annual savings net of the debt service of $108,000 per year. Now, in a typical bank financing scenario, you'd be looking at a shorter term, 5 to 7 years, and you would not see a positive debt service coverage probably during that entire time. So that's another advantage of the C-PACE, is that it's immediate. Besides no cost in, no down payment, no out-of-pocket cash up front to do it, you have immediate cash savings. Key financial metrics are shown here, and again, this is just a summary of the savings to the investment ratio, showing that this is positive. Shows the net present value, which is positive, which suggests that this will return greater savings than the cost of the project. This is the projected cash flows, and this is just a breakdown. We saw the summary on the previous slide, and this just shows the yearly cash flow. And as I mentioned before, in this scenario, it's positive in every year. And so again, there's no out-of-pocket expense, and it saves money beginning in year one. Key assumptions. This is a summary of the key assumptions used in the projections. Again, the assumptions would be the income tax. The capitalization rate is the cap rate. That would be based on the value of the property, and that goes into calculating the increased value of the cost savings of the energy savings equipment to the value of the property, because it is tied to the property. So again, a lender would look at this and say, with positive cash flow, this equipment adds value to the property and actually increases the value, which would reduce the loan to value on the existing debt. So that would be a positive reason to approve the subordination of the lien. Again, just some of the assumptions used in here, tied to the savings, which would be what utility rate escalations are, and then is factoring the amount financed. The slide talks about the energy conservation measures used. So this is a detail. This isn't all inclusive, but just gives you an idea of detailing all the equipment that is putting in, the useful life, the cost, and you really get a return factor based on that. So all these things go into the financial projections, and you get a summary. We already kind of talked about this, which is the project cost, which in this case there are some incentives. So the project cost was $2.4 million in this example, but there's $400,000 in utility incentives, bringing the project cost down to around $2 million when you add in all of the fees associated with it. The last thing I wanted to mention was the appraisal addendum, and again, this is very important if you're doing a project either on the front end or you're adding significant value or significant cost to the building. You'd want to have an appraisal done that would include this green and energy efficient addendum, which would capture the value of the improvements. So that really is briefly an overview of what a bank or a lender would like to see. They'd like to see that the project does add value and does reduce cost, and that would improve the current lien position of the lender. And with that, it is a very compelling argument to grant consent to the C-PACE financing. I hope that was useful. There's a contact for me. I think my email is included here, and you're welcome to contact me if you have any questions. Thank you.